Hello everyone, it's Friday, March 13, and today we will review the charts for the euro and the pound to identify potential market trends. As you can see, both the European and British currencies remain under pressure. The dollar's earlier upside momentum triggered by Donald Trump's statement at the start of the week suggesting that the Middle East conflict could soon come to an end and fizzled out. Traders and economists are now focused on the latest developments, which indicate that the military conflict is intensifying. Yesterday, Iran threatened to escalate attacks on EU targets if the US and Israel continue their actions. Tehran also stated it would maintain its blockade of the Strait of Hormuz, while Iranian officials have indicated that navigation through the strait is possible with military permission and transit is effectively paralyzed, which is a key factor driving prices higher. Despite US efforts to free oil vessels and ease price pressures, oil prices continue to rise in response to the broader global environment. Regarding fundamental statistics released yesterday, traders received positive news from the US labor market, with initial jobless claims falling below analyst expectations. Additionally, the data on the US trade balance was encouraging. In this context, the dollar gained fresh upward momentum against the euro and the pound sterling, which have already reached new one-month lows and are likely to remain under near-term downward pressure. Before we dive into technical analysis, let's take a look at today's macroeconomic calendar. It features UK GDP growth data for January, with the British economy expected to expand by 0.2% following a 0.1% gain in December. Disappointing results could add to the pressure on sterling. The UK will also release data on industrial production, forecasted to show a modest 0.2% increase, along with the goods trade balance likely to remain in negative territory. Besides, reports on services activity and construction output are expected. If UK statistics fall short of expectations, the pound will struggle to enter any bullish correction. And the Eurozone market participants will be watching industrial production data, as well as consumer price figures from France and Spain. Later in the day, attention will shift to important US releases. Fourth quarter GDP is expected to remain unchanged at 1.4% compared to preliminary estimates. Only a worse than expected figure could weigh on the dollar, potentially allowing for a bullish correction in the euro and the British pound as the week closes. All eyes will also be on the core PCE price index, the Fed's preferred inflation gauge. Projections for January 2026 suggests strong monthly growth of 0.4%, matching the increase recorded in December. On a year-over-year basis, the PCE price index is anticipated to edge up to 3.1% in January, up from 3% in December. Stronger than expected readings could bolster the dollar, influence the Federal Reserve's future interest rate decisions. Moreover, data on personal spending and income will also be released. Overall, today's calendar is packed with significant updates. Given projection, the US dollar is likely to remain in demand, unless unexpected comments emerge from the White House or Donald Trump. Turning to technical analysis, the 1-hour EUR USD chart indicates that a false breakout at 14.94 and 14.72 could generate a buy signal. Long positions on the rebound could be considered around 14.33 with a target of 35.40 pips move. Short opportunities may arise at 15.27 and 15.65 on a false breakout, or at 16.09 on a rebound, aiming for an intraday correction of 25-20 pips. Regarding the British pound, the trading setup is similar. A false breakout at 33.25, especially amid positive UK GDP growth data, could trigger a buy signal, pushing the pound-dollar pair higher to 1.3367. A break above this level would lift sterling to 34.06 and potentially open the way to 34.40 32.40 if US data disappoints. At this level, I recommend going short on the rebound, aiming for a 25-30 pip correction. Short entries at 33.67 and 34.06 should only be considered on a false breakout, counting on the continued bearish trend observed since March 10. If buying activity remains muted amid disappointing UK statistics, a break below 33.25 would generate a sell signal, dragging sterling down to 32.86, with the furthest target being 32.55. At this level, it would be wise to go on a rebound, targeting a 25-30 pip move. Long entries at 32.65 and 33.25 would be only relevant on a false breakout. Good luck to everyone, and have a great weekend.